Good morning, traders. I'm Dennis Dick.
And I'm Joel L. Conan. Welcome to Pre-Market Info. We're here for an update on some very interesting trading action in Dollar Tree off the open today.
Yeah, Dollar Tree had a flash crash here this morning. In a 1 second period right after the open, Dollar Tree falls from $47 down to $38.40. And then in the next 8 seconds, it rallies all the way back up to 47. We've talked about this on the pre-market info shows. We've reiterated that there is very little liquidity at the open, and especially on stocks that just reported earnings. So when a big institution or when somebody sends a large order into the market, it can really impact the price at this time. But what's interesting about this flash crash is that on the way back up, internalizers were taking advantage of the fall and they were buying from retail market sell orders as the stock climbed back up.
Okay, so let's set the scenario a little bit. Bad news is delivered by Dollar Tree. Disappointment in the earnings, lower guidance. The market opens and someone comes in with a piece to sell.
Yeah, market opens at 47.75 here, and then the stock starts to sell off. But none of these trades, if you look at them, are very big. It's all 100, 200, 300 shares, but trading actively here in the first second. But then in the next second, the stock price starts to fall. And you can see on the chart, it actually falls so quickly and rallies so quickly, it just shows up as one bar here. But it ends up falling all the way down to 38.40. So if we just look at the trades as they scroll by, here's the price and here's the size. You can see it's all little stuff. So it's not like a huge big sell order is here. It's just simply a bunch of small orders. So I'm not sure if you've triggered some stops here as the stock's price starts to fall and then that just continues to fall, or if some institution was sending just a large algorithm just sending in smaller orders for a large quantity. But as you can see in the first second there, it falls from 47 to 45, and then in the next second it really starts to fall.
Right, and as you could well imagine under this scenario, there's a lot more sell stops on the book than there are bids.
That's just what happens. Is there is stop orders out there on stocks like this. Traders put stops, and as soon as the price goes through there, it starts getting executed. And as you can see, like it falls from 45 to 44 here, basically in just a few prints. So there's really nothing even between this 45 and 44 area. There's just no liquidity off the open. High frequency traders do not provide liquidity off the open because there's too much risk. They want to wait until the price stabilizes, and then they'll start providing liquidity. And especially on a stock that's uncertain, that just had earnings, they're not providing liquidity at all, and you don't have the traditional liquidity providers anymore. Those traditional liquidity providers have been pressed out by the high frequency traders.
And just for a quick lesson here on stop, but I bet you a lot of stops I bet you those 40 sell stops got filled, got nailed at 38.40.
Well, that's just it. They get executed the best available price, and they go into the market. And if there's no liquidity there on something like this, you could be printed a dollar or two down. Like, look here, it falls from 40 to 38.75 on 500 shares. So
no way.
Yeah, well, there's just nothing in there. So basically, the liquidity is all fragmented. You've probably got 10 or this 15 exchanges. There's a few hundred shares on each one, and it just takes it all out and gets all the way down there to 38.40. So, like, we talk about these flash crashes all the time, and I don't want to start boring our listeners because here's another flash crash. But this one's even more interesting because it happens right at the open, and then what happens as the stock's rally? If I just scroll up the tape, it bottoms at the 38.40 like you can see on the chart, but then it starts to rally, and as it starts to rally you start to see these sub-penny prints here basically happening. I'm just scrolling it up. It's just fallen. So basically you're just seeing the trades 41, 49, 39, 98. They're kind of all over the place because on some exchanges there's a best bid of 41, 48 and 38.58, and these are all getting executed instantaneously. But what's interesting is if I do scroll up the tape is on the way up, as it starts rallying in the next 8 seconds, you'll start to see these sub-penny prints happen. And basically what's happening is there's retail sell orders that are coming in, market orders from retail traders that are coming in, and the internalizers who are getting these orders see that there's huge bids coming in and that the stock is rallying back, and they start to execute against these sell orders and buying the stock in front of whoever is bidding. So for instance, there's a print here 43.39.01. Well, some traders come up and saying, look, this is stupid, this stock's going to come back, I'm going to bid 43.39. Somebody tries to sell it to him, and the internalizer, OTC market maker, intercepts that order and trades and takes that sell order for themselves. So the guy sitting at 43.39 probably doesn't get filled, and the internalizer steps up and buys it. And you can see it starts to happen rapidly here.
Yeah, 2 points here. One is if you have a position in an issue and something like this happens, let's say Dollar Tree, let's say you're fortunate enough to have a short position, you have to put your bid out on the way down, because if you don't have your bid on the way down when there's momentum going down, what Dennis just discussed, the internalizers are going to jump ahead of you. I mean, we've both traded in situations like this when, there's just a crazy move in the stock and you want to get in and you're bidding, you're bidding even, you're bidding a quarter. Sometimes you bid a half of a point above the market, and no matter what, you're still not going to get it, because an internalizer, if you go half bid, they're going to come in a sub penny ahead of you and get that. If you go 3/4 bid, they're going to, even if you're wrong, they'll jump in front of you.
Yeah, they're jumping in front of the bid, and that's what you can see. It's rapidly starts to happen here because they've realized here, well, this is just some ridiculous price move down. We want to be buying from every market order that is coming into the market right now. And so somebody bids 44.38, they step in front, buy 44.38.31. They bid 43.31, they step in front, 43.31.01. They bid 44.01. They bid 44.15, 44.15.01. And for the most part, the participant that's actually bidding there and they're stepping ahead and trying to buy it, they're not getting filled because the internalizer is taking all that stock. Look how many times here they're just stepping in front. You don't see any of this on the way down, but when the stock's bottomed and is rallying up, the internalizers realize, hey, this is cheap right now. We got to buy from all these market orders that are coming in that are to sell the stock, and we're going to make a quick buck. And that's exactly what they do here, basically taking advantage of the limit orders that are coming in and buying the stock for themselves.
Well, you probably have the opposite on the way down. Once this thing started to crater from the $47 level, if someone goes offered for any kind of size, which in this market would be 1,000 shares, they go offered at 47, boom, 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 the internalizer at 46.99.9999, and the whole way down. It just works in reverse effect. If there's momentum to the downside, they're hitting, they're getting ahead of the offers, wanting to wipe out the book, and then on the opposite, on the upside, when bids started coming to the market, they'll you can't win. You can't win on the way down, and you can't win on the way up.
Yeah, you've got to be. If you were providing liquidity off the hop there on the open, you would have been filled. But once it started rallying, and if you're trying to come in and buy this thing, quickly, a second or two later, and you're putting your bids out there, they're stepping ahead. There's high frequency penny jumpers that are probably stepping ahead of your orders, and then there's the internalizers that are stepping ahead of the high frequency penny jumpers. It's a big game of leapfrog.
I mean, stocks can have volatility and they can have, large price swings. But when the retail trader or the prop trader cannot participate at the same levels that institutions are in high frequency traders, I mean, it's a rigged game. Yeah. I mean, how are you going to play this game? You can get filled in sub-penny prints, but you can't post a market in sub-penny prints.
Yeah, it's ridiculous that they're allowing this. And this has been going on for 3 years. I've been talking about that, and we've been talking about this. It's ridiculous that they allow some participant to step ahead of a display limit order for a fraction of a cent. And you can see how much money these internalizers basically take from the limit orders that should have been filled as the stock was climbing. They just step in front for all these prints, all these sub-penny prints you can see here. It's ridiculous. The whole structure is just messed up.
What's it going to take for the regulators to I mean, this is now, you take the night debacle and then you take everything that goes on every week. It's just building itself, into a frenzy. When is our government going to take a look at it? Well, better, maybe not. I mean, if the government gets involved in it, then it could get worse, right?
Yeah, I don't know. Like they're trying, and this has been something that has been the SEC has been looking at for a long time. But there's still the arguments that overall the market structure is still stable. They're providing price improvement. That's the justification on the other side, is they are giving price improvement to the retail sell order. The retail sell order that should have been filled at 43.31 got 43.31.01 in this case. So they saved themselves 1 cent on the 100 shares or $4,300 order. So instead of getting $4,331 for their order. They get $4,331.01 for their order. That's the justification. They're saying that that's what they go by, and they say they're providing this price improvement. But our argument would be they're stepping in front of this limit order trader, and they're taking that money away from him. It's just ridiculous.
It's just amazing. I mean, you talk about, so you said it went down in a second and came back up in 8 seconds?
Yes.
Okay, and that just to show you how unwarranted that trading activity was, is look at Dollar Tree now. Since 1025, has traded in basically a 33-cent range between 47.31 and 47.64 for the past almost 25 minutes.
Yeah.
I mean, so that just makes an incredible case that this activity here was driven by computers and should not have taken place.
Well, it's driven by the lack of computers really off the hop. Like the high-frequency traders say all the time that they provide liquidity, but they're not providing liquidity off the open, and that's why you can have, a bunch of 100-share orders hit some stops, and all of a sudden the stock falls $8 or $10. So you can't really blame the high-frequency traders for knocking it down here, but you can say, I'm just trying to argue that they don't provide liquidity all the time, and at these times, these critical times when the market opens, that's when you can have these huge moves down because their traditional participants just simply aren't there. There is nobody providing liquidity in the first few seconds of trade, especially on a stock that just had earnings. That's the overall argument, folks. We hope we've given you a little bit of insight into this high-frequency market structure that we trade in. They provide liquidity when you don't need it, but when you need it, they are nowhere to be found.